Very good afternoon, everyone. A very good afternoon, everyone. We will be talking about basics of derivatives and how to take advantage of derivatives. And before that, I'll briefly talk about myself, and then we will look at derivatives. What are the opportunities there? What are the do's and don'ts? So I'm Amar Singh. I head the equity advisory at Angel Broking, and I have more than 15 years of experience, work experience, and I've been into the financial markets for almost 15 years. So I look at both the markets from a technical perspective, fundamental perspective, and also the derivative perspective. So what I have understood is that derivatives are an opportunity if one really understands it well. So the objective of this webinar is to help all of you who are there to understand the basics of derivatives, what are features, what are options, how you can take advantage of them, what are the pitfalls, as well as what are the opportunities. Apart from that, I'll briefly touch upon the trading psychology, and at the end we will have a 15-minute session for question and answer. So you can ask your questions at the end. You can type in your questions, and I shall revert on the same. Yeah, so the structure of our webinar is basics of derivatives market, futures and how they work, options and its potential, and key trading concepts. So coming to the derivative instruments, we all talk about the cash market, and many of us understand the cash market very well. But few of us really understand the derivatives and how they work, and what are the opportunities there, what are the risks involved. So I will be giving you an idea on that. Derivatives are financial instruments which are leveraged in nature, and they derive, the word derivative is from the word derive, so they derive their value from an underlying. And also derivative instruments, they have an expiry date. Just to give you an example, if you are buying Infosys as a stock, you can buy the stock and hold it for years and years if you so wish. But if you are trading Infosys futures or Infosys options, all these contracts, derivative contracts, they have their expiry dates. So the contract would expire on that particular day. So if you wish to hold, say for example, Infosys futures or Infosys options, you will have to roll over. You will have to roll over, and then you will have to buy in the next contract. So the second is that derivatives are leverage instruments wherein you trade on margins. Say for example, if I'm talking about the stock futures, stock derivative instruments, and particularly stock futures, today the margins could be anywhere between 15-20% to 30%. If I'm looking at the other asset classes in commodities and currencies, then the margins could be less, maybe 10-15%. So that depends specifically from asset class to asset class, and also depending upon the value of the asset class. So that is one opportunity. Whereas in cash market, if you are trading, so you will buy only to the extent that you hold funds. So there is this advantage of leverage. But you need to understand that is leverage cuts both ways. If you don't understand how to manage leverage, you could be in serious trouble. But if you understand how leverage works, then you can definitely take advantage of it as well. The other major advantage of derivatives is that you can trade both the long and the short side of the market. So for example, we just like the seasons that we have, the summer season, the winter season, the rainy season. In markets also, you may have a bull market, a bear market, and a sideways market. So derivatives gives you the opportunity to trade all markets. So if you're bullish on the market, you can be long, you can trade on the long side. If you're bearish on the market, That means you feel or you have certain information based on your analysis. You understand that the market is likely to witness selling pressure, so you can short the market. That means you can short sell the market, and you can make some money on the shorting opportunity. So you can take advantage of both the long and the short as far as derivative instruments are concerned. Then also you have different opportunities which are available as traders who take time out to understand them well. Now coming to futures instrument, because derivatives generally you'll hear the term FNO, that is futures and options. So futures and options, again, they are very popular, and they are, as I said, they are leverage instruments. So first I'll briefly talk about futures instruments, and then I shall talk about options. Uh, so few, first I will talk about futures, and then I shall talk about options. What happens is that when I'm talking about futures, futures are leverage instruments, again, which are they are exchange traded instruments. So when futures are exchange traded, so they are traded on your stock exchanges, on your commodity exchanges, on your currency exchanges. So you can take advantage of the leverage. So you have a margin, so you have lower margins. Say, for example, just to give you an example, if you want to buy Infosys stock worth 1 lakh rupee, so in that case, if you're buying in the cash market segment, you have to pay the entire 1 lakh rupee. But if you are trading in the futures market, your margins could be anywhere between 20% to 30% of the uh, overall contract value. So if the contract value is say 1 lakh, just to give you an example, generally the contracts have a value of 5 lakhs or 6 lakhs. But in this case, just to give you an example, if it's a 1 lakh contract value, so the margins could be anywhere between 20 to 30%. So between 20,000 to 30,000 is what you need to pay. So futures gives you that leverage advantage, while at the same time, if you are trading the markets from an intraday perspective, you can take higher leverage as well. So it has its own advantages. As I said, leverage has its own advantages. Leverages has its own advantages, and also what happens is that each of these futures contracts which are there, they have their own contract specifications. So the futures contracts have their own contract specifications, that is in terms of the lot size of that particular contract, futures contract, and apart from that, when is the contract expiring. Say, for example, if you're looking at Reliance, so Reliance, the lot size is 500 shares in one contract. So if you're buying a futures contract, so effectively it means you're buying 500 shares of Reliance. So, but at the same time, you're trading on leverage. So if Reliance stock moves from say 1070, it goes to 1100 rupees. So effectively, you are earning 30 rupees per share. But since you are holding 500 shares, so effectively it means that you are making 15,000 shares. That is 30 into 500. So effectively, you are making 15,000 rupees on that particular trade, and that again on a margin. So futures gives you that advantage of trading on leverage one, while at the same time, if you are bullish on Reliance, you are buying it at 1070. But suppose you are bearish on Reliance, so you could have sold Reliance at 1070, and if Reliance from there corrects to 1050 or so, you would have made a 20 rupee gain. Again, that translates into the number of contracts, number of shares per contract, that is 500 shares in the Reliance futures contract. So 500 into 20 is you would have made 10,000 rupees. But just as you could make money, you could also lose money if the trade goes against you. So you need to understand how you need to manage your risk and your losses. So for that you have the stop loss. I will be talking about that towards the end of the session, because that's also a very critical part when one is dealing on the futures and option side. So the advantages, as I said, is you can trade on margins. That's one. You can be If you're bullish on the market, you can trade the market from the long side. If you're bearish on the market, you can trade the market from the short side. And also, you need to remember that futures contracts, each and every contract, there are close to 175, 180 stocks which are in the FNO segment. Out of that, roughly around 80 to 90 are very liquid. Out of that, around 20 to 25 stocks are most liquid. So, and if you look at the futures and options, again, Nifty and Bank Nifty. Nifty and Bank Nifty futures and options, they are the most liquid of all, and they have the maximum value. If you look at the overall volumes on the exchanges, more than 85-90% of the volumes happens in the top futures and options segment. So you have this major advantage. At the same time, you need to remember that futures and options are basically more from a trading perspective. They are not from an investment perspective. You can, however, use futures and options to hedge your positions, your existing cash positions. But majorly, you need to remember that that's more from a trading perspective. Why is that? Because futures contracts, each, as I said, derivative contracts have expiry dates. So the futures contracts or the options contracts on the equity side, they expire on the last working trading Thursday of the month. So it is the last Thursday of the month, which is a trading day. That day the futures and options contracts expire. So if you are holding till expiry the futures contracts, you will and you want to hold on to your position, then you will have to roll over to the next contract. Say for example, we are in January 2017. So 25th January is the expiry of the contract. So for that matter, if you are holding on to your trades and you are still bullish of say Reliance, as I example that I took, at 1070 you bought, and from there it is going higher towards 1100. So you want to still hold on to your position. So you can buy the futures February futures contract. You can square off. That means you can sell your January futures contract. That is squaring off your trade, because you have bought at 1070. It is currently around 1100. So you are selling there. But the moment you are selling, you are building a position in the February contract. So that advantage you have in the futures contract, but you need to remember that futures and options, basically the derivative instruments, are more from a trading perspective, one, and secondly from a hedging perspective. That means you can hedge your portfolio. So this is the major, I would say, and every stock has its own lot size. Like if we are looking at Nifty, the Nifty lot size is 75. So 1 point move in the Nifty futures can fetch you 75 rupees, or if it goes against you, you lose 75 rupees, but that's just notional till the time you actually book your profit or your loss, that is you square off your trade. So you have a major opportunity here on the future side, and as I said, if you can manage your risks well, this can be a great opportunity. Now we shall talk about options. So looking at options, you all would have heard about option trading and options. So options are basically, they are again derivative instruments, they are again leverage instruments, but you have an advantage in options. That advantage is that when you are buying a futures and you are holding your futures, you can have unlimited profit, but at the same time losses can also be unlimited. Meaning, if the market falls significantly and you don't have a stop loss in place, or you don't have a money management strategy in place, you could lose. Large sum of money. But when you are trading options, what happens is that when you are buying options, you are buying a. Yeah, I will just take a time here. So what happens is that when options again are derivative instruments, and they are again leverage instruments. At the same time, if you are bullish on the market, then you will buy a call option. and if you are bearish on the market, then you can buy a put option. The advantage of buying options is that your loss is limited to the extent of the premium that you pay. So, say for example, if we just take a Reliance example, that a Reliance stock is currently trading at 1070, and then you have different strike prices for the call option for Reliance stock. So a 1100 strike price for Reliance. I'm talking about a call option because you are bullish on the market. So you buy a 1100 strike price call option and you pay a premium of say 13 rupees or so. So, and Reliance, as I said earlier, has a market lot size of 500 shares. So effectively what it means is you are buying 500 shares of Reliance with a total premium that you are paying is, if the premium is say 13 rupees at that point of time for a 1100 strike price. So, and then Reliance starts moving up. So the stock starts moving up from 1070, it goes to 1080, 1100. So effectively the stock has moved up by 30 rupees. So ideally you should be making a profit of 30 rupees multiplied by 500, that is the lot size. So that is roughly 15,000 rupees. And what is the total investment that you have? That is 14 rupees if you buy the call, the premium, and into 5. So it is effectively a 7,000 investment. But then that is not exactly the case. So why is that? This would have been the case in the futures side, because in futures, even for one tick move, you make money or you lose money. But in options, there is something called delta. I will just explain it very briefly and for your understanding and very simply in simple terms. That delta is nothing but the percentage change in the option price vis-a-vis the underlying price. Say for example, if the Reliance has a delta of zero point 0.6, so what it means is that for a 1 rupee move in Reliance, the option will move by 60 paise. Or if the delta is 0.3, so a 1 rupee move in Reliance stock, that is Reliance goes from 1070 to 1071. So in that case, the option value will increase by, it would increase again by 0.3%. So it would increase in that proportion. So options are a very good trading opportunity, wherein you will find that the stock is giving you an opportunity to trade in options. So call options you trade when you are bullish on the market, and primarily one should be more on the buying side of options till the time you really don't understand, because there are many people who write options, that is who sell options, but that is a comparatively a more experienced play, and the one who's been trading derivative markets for many years. So they could have some strategies on this side, but more or less to start with, buying a call option or a put option is more required or is essential, because in that way your risk is limited. If you buy a call option, as I said, for Reliance, you bought the 1100 strike, so you have paid 14 rupees the lot size. So 14 into 500, that is 7,000 you have paid as a premium for the Reliance option for a strike of 1100. So Reliance is at say 1070, so you could have a strike of 1080, 1090, then 1100, and again you could have, so you have different strike prices which are, so you have different strike prices which are there for every stock. of 1, so 0.6, 0.7, the better off you are, because now I will talk about other concepts of options. To briefly tell you is that when you are bullish on the market, you can buy a call option. When you are bearish on the market, you can buy a put option. So, but you need to remember that just buying a call option and holding it for a very long period of time will not help you, because there is something called time decay in options. Effectively, what it means is that suppose you buy Reliance today. Today is the 4th of January. You buy Reliance option 1100 option at 14 rupees today, and the current Reliance's price is 1070. That is the cash market price is 1070. For the next 1 week, suppose Reliance trades around 1070 or so, what will happen to the value of the call option? So from 4, it will no longer remain at 14. You will find that the call option value has come down from 14. It may be, it could come down to 10 or 8 or 9. Why is that? Because as I said earlier, that all these derivative instruments are basically, they have their expiry dates. So the option will also expire on the last losing in value. So if you're buying a call option and the market is not going anywhere, you are losing premium on a daily basis. So you need to keep that in mind, that just buying a call option and or a put option for a very long period of time and the market not going anywhere, you're not likely to make much of a money. You could basically lose some money there. So you have to be careful as to when you buy options, either a call or a put. So for short durations, if you buy and hold, it is a very good opportunity. You can get very good opportunities because it gives you extremely highly leveraged trades, one, and also your risk is limited. Just to take a minute here, when you're buying a futures, when, say for example, you're buying Reliance futures at 1070. Now Reliance futures from 1070 say falls down to 1000. So effectively on one share you are losing 70 rupees. So net on 500 shares, because the Reliance futures lot is 500. So effectively you are losing 70 into 500, that is 35,000 rupees on one contract. Likewise, if Reliance goes up from 1070 to 1170, so you are earning 100 rupees per share, but you have a lot size of 500. So 100 into 500 is 50,000. So you could make 50,000, you could lose on the downside. If Reliance falls by 70 rupees, you could lose 35,000. If it goes down further, you could lose even more. So that is the advantage, you can say, or the disadvantage of futures. That is your, as I said, the risk is unlimited and the reward is also unlimited. Why is the risk called unlimited? Because if you're buying a futures contract, if the stock starts falling significantly, and if you don't have a risk management or stop loss in place, then you could be in trouble. Likewise, if you have gone short in futures, and if you have say got you have sold Reliance futures at 1070, and Reliance futures starts moving from 1070 to 1170 and then 1270, so you started losing big money on that particular one. So the point here is, what I'm trying to say is that if you trade futures or you decide to trade futures, you definitely should have a stop loss in place, a risk management in place, some concept, some level where you will exit the trade if the trade goes wrong. But that you fear you don't have when you are trading options on the buying side. So if you're bullish on the market, you buy a call option. If you're bearish on the market, you buy a put option. So generally what happens is that if I'm looking at options, overall options, there are three types of options. You have at the money option, in the money option, and out of money option. This is a very simple concept, but a very critical concept when anyone is trading in options. At the money, you can just understand from the word itself that at the money option means what? That if the Reliance stock is share is trading at 1070 and the option Reliance strike price is, there would be different strike prices. As I said, it could be one, there will be 1070, 1080, 1090, 1100, 1110, 1120. If it is that, or on the downside, again it will be 1060, 1050, 1040. If it is that way, so somewhere very close to the cash market, that is the at the money option. So wherein which is at the money option. If the stock is in deep in the money option. For call options, what it means is that if Reliance is trading at 1070, so all strikes which are lower, they would be in the money option. Whereas for the put options, it would be the reverse. So what happens here is that you need to stay away from deep in the money options. You need to stay away from deep in the money options. And what it means is that suppose it is trading at 1000, and then it's trading, you have 1060, 1050, 1030. So you don't really need to trade too deep in the money options, because here you will have to pay a very high premium, and also you will be the biggest loser in case of time decay. The biggest disadvantage here for the option seller is time decay. Whereas if you are buying an option deep in the money option, that has less of time decay and more of intrinsic value. So you need to understand a couple of things, that also you need to stay away from deep out of money. So deep in the money option also you need to avoid, and deep out of money option you also need to avoid. Say for example 1070 is the current price of Reliance. So at the money option is 1070, then deep in the money, in the money options will be 1060, 1050. Deep in the money could be even lower. Out of money would be 1080, 1090, 1100. Then deep out of money could be 1130, 1150. So what happens is that if you are buying deep out of money call options, you will pay very less premium. And if you're buying deep in the money options, you will have to pay very high premium. So neither of this is advisable. So what you need to do is, you need to trade slightly out of money at the money, or slightly in the money options. So here you have a reasonable chance or probability of proving profitable when buying options, and also they are generally the most liquid, because you will find that options have different strikes available for a particular stock. So you should trade in the most liquid of options, and generally you will find that most liquid of options are either at the money, slightly out of money, or slightly in the money. And then there is a time for all seasons, means that you need to understand when the market is bullish, when the market is bearish, or if the market is trading sideways. So in a bullish market, you are buying options, then you should ideally buy a call option. The other way, or some, I would say, professional traders, instead of buying a call option, they will sell a put option. So they are taking a position by selling a put option, because effectively, as I said earlier, that when you are bullish on the market, you buy a call option, but if you are bearish on the market, you will buy a put option. So these are the basic, I would say, derivative instruments, and majorly you will find that the significant volume happens on Nifty options and Bank Nifty options. Nifty options are monthly options, just like the stock options. Whereas Bank Nifty options are weekly options, so they expire every Thursday of the week. So you have increased volatility in Bank Nifty options. And what I have seen is that if you take the time out to understand options or futures, and then also you have some concept of risk management or stop loss concept, then you can really take advantage of these derivative instruments. Because there's a very nice saying that if you feel that knowledge is expensive, try ignorance. So the point here is that you need to learn on it, you need to understand it even better, which can help you trade options better and futures better. And as far as trading is concerned, you need to have, and it's not only for options per se, it is across the board, whether you're trading the cash market segment or the futures or the options, you need to maintain a stop loss. That is, you need to know or understand or realize when you have gone wrong in a particular trade, or for that matter, if we don't use the word wrong, I would say the trade goes against you, then you should know where to get out of a losing trade. Secondly, in futures and options, you should not average your losing trade. Meaning, if you're losing money and then again you average that losing trade, that is not a very wise thing to do. And as the option nears the expiry, the value of the option reduces due to time delay. So you need to understand, as I said earlier, that don't just because you are bullish on Reliance, a call option of Reliance, and Reliance does not go for a few days, it's rallying, but still made any money. For time decay has eaten the premium of your option. And when Reliance starts, at that time your option is just at par, still you are losing money. So buying options, your timing has to be I will not say perfect, but timing has to be good. And the shorter the time frame that you hold your options position, that is on the buy side or the sell side, that is a call option or a put option, the greater the probability of your making money. And the other advantage, what I've seen is when you are trading options, you're buying call options. Sometimes the options they grow many-fold, and a 5 rupee option premium could become a 20 rupee option in a couple of days, and that happens on a daily basis. If you're looking at Nifty or Bank Nifty for that matter, Bank Nifty from almost 50, it had gone up to 250 in a couple of days. So again, from 250 it collapsed and came down to 120, 130. So what I'm trying to say is that there is a huge opportunity in futures and options, provided you take out the time to understand them. And you need to also remember that there are rules. Every game has its own set of rules. So trading is also a set of rules where you have to define what you need to do when you are right and what you need to do when you are wrong. So that will ideally help you. And always you when you're buying options, you need to remember that your losses are limited. So you need to buy, as I said, buy at the money option, or slightly in the money, or slightly out of money. Don't trade in far out of money options. That's not a good thing to do, because you might pay very less premium to buy, and you will find that, oh, it's very cheap, you can buy. But ideally, you will find that the possibility or the probability of your making money by buying deep out of money options, that the possibility and probability is extremely remote, until and unless the market sees a major move, or the stock that you have bought sees a major move in your particular direction. So, summing it up all together, I will just talk about that. Generally, what happens is that when we, as a trader, we enter the market, we don't spend the time that is required. We don't acquire the knowledge that is required, because the moment, if you look at it from this perspective, that if you are having knowledge on your side, your level of confidence will also be high. So the dynamic places that you consistently need to update and upgrade your knowledge, and we at Angel definitely can help you in that regard, as to whatever help and support you need or require in terms of understanding derivative instruments, because this is a basic, I would say, basic discussion on futures and options, but we could have detailed presentations also, which could help you and aid you take better decisions. So the first point is, as I said, was lack of knowledge. But lack of knowledge, we all somewhere start with lack of knowledge, but over a period of time, we gain in knowledge through experience, through working with people, through understanding from people, and then we decide the path which is best suited for us. Options, as I said, options and futures, you have to first of all understand your risk appetite, your capability to take risk, because it's a high leverage game, as I said, high leverage segment, as I said. So you can have the opportunity to make a lot of money, and but at the same time, you need to know how to protect your trades which goes against you, how to exit loss-making trades. Second is lack of patience. We generally tend to want results in a very short span of time. We lose patience, and also, so markets also test our patience. You need to understand that markets, we are all emotional beings, and markets is nothing but the complete universe of emotions of all the market participants. So we have to somewhere control our emotions when we are in the markets, and whichever asset class we trade in, if we don't control our emotions, then definitely we are most likely to end up taking a wrong decision. Again, as I said, emotions are not a good place, at not a good, I would say, feeling to have in the markets, and also having patience is required. And the most important and critical aspect is the risk management. As I say, risk management is nothing but knowing where to exit your trade if the trade goes against you. Because we all are optimists by nature, and we all live on hope. But there's a very nice saying also, that if there is no hope, what else is there to live for in life? But in markets, there is really no place for hope. So somewhere or the other, if the trade is going against us, then we need to exit the trade, eject from the trade, and always remember that there is nothing called right or wrong. There could be trades which could go in our favor, trades which could go against us. So there's nothing that we need to take personally. We just have to learn what we can from to the best of our ability from the trades that we take. So here risk management helps you, because what risk management does is basically it's more of a parachute, that a diver who's jumping from a 30,000, 35,000 feet, he has a parachute, and he's assured that the parachute will open, and he'll be saved. So the risk management or the stop loss concept is also works on the similar principle, that it will help you prevent major losses, because if you take significant losses, then that impacts psychologically, financially, emotionally, which is again not a good state of mind to be in while trading. So having a stop loss will help you there. So this was what I wanted to cover on derivatives. It is a wonderful, I would say, area to be in. If you take out the time, you can start in a small way. You can, first of all, you need to really understand, and then it's just like a baby. It starts crawling, and then starts standing, then starts walking, then starts running. So it's the same with the markets. We need to take slow steps at a time, understand, increase our knowledge, that increases our confidence, and then we trade accordingly. So now we can have questions. You can ask your questions now. There is a chat window on your right hand side, so you can ask your questions. Okay. The first question is how to understand the time decay in option strategy. Overall, you need to understand what happens is that when we are looking at I'll just give you a comparative analysis that when we are talking about futures, so futures you don't have a time decay. So if you're buying, say, Reliance at 1070, and Reliance you're holding till expiry, that is 25th of January, and that day also Reliance closes at 1070. So net you will not lose any money. You will not lose any money on that trade. But just to give you the options perspective, is that you are buying a 1100 call option in Reliance, which again expires on January 25th. But Reliance is not going anywhere. So the Reliance overall, you will find that the Reliance call option, which is available today at say 14 rupees premium, that will reduce, and eventually if Reliance does not go significantly higher, you could lose your entire premium. And it is basically just as I said that delta is a measure of the movement in one. It basically gives you the percentage movement in option vis-a-vis the underlying stock. Likewise, for time decay, you have the theta. So, which tells you as to the time decay in the options. So you need to look at that perspective, but you can be rest assured, as I said, to start with as a ballpark, you can have a look at the at the money, slightly out of money, and slightly in the money options for the trading purpose. The next question we have is on the margin point. That generally what happens is that when we are trading futures particularly, so in that case what happens is that we have a leverage instrument. Futures, as I said, derivatives are leverage instruments. So in that case, when we are buying a futures contract, we will pay margins. There are you have different margins for all these FNO stocks. So, but relatively the margins could be anywhere between 15-20% to 30% or so. But you also have the advantage of leverage. If you are trading intraday, you can trade on high leverage. But again, as I said, you need to realize fully well that taking high leverage, you can make a killing, but at the same time, you can get hurt also if you don't know how to manage your position. The other point is that on the futures side, that if the market opens with a down gap the next day, and you have a stop loss in place, and the stop loss does not get triggered, then you have to then you can be taking a larger loss, which is not the case when you are buying options. If you are buying a call option or a put option. Now we shall take the next question, which is what is the view in market for pre-budget? See, overall, what we are seeing currently in the markets is that I'm talking about the major market indices. We've earlier seen sharp selling pressure almost from 8970 levels. Nifty corrected to 7990 levels. So that was a selling that came in, and currently the markets are close to 8200 levels. So they have witnessed a bounce back from the lower levels. So till the time the 7900 level holds, overall higher upside, I would say short term perspective, 8272, 8300 is a level to watch out for. As far as the budget is concerned, budget is expected to be pro tax, pro corporate. It could be pro tax, also pro industry. So we'll have to watch out for. But yes, there are specific sectors which have really taken off, like the reality sector and the housing finance companies, which have taken off on the account of the interest rate cuts. That's one of the major rate cuts in recent history of almost almost 100 basis points. That's almost 1% by all major banks, be it the SBI or the other public sector banks or private sector banks. So that's somewhat helping the markets, but we'll have to watch out for the budget, because the budget will set the trend and direction for the markets. Also, there is another aspect which I think you should look at is the FII flow. FIIs have been continuously selling in the markets, but their selling is now subsiding. So till the time we don't see continuous buying coming in from there, we could see some sideways consolidation in the markets. We'll take Okay, we'll take the next question. How to know which stock to enter in call or put? That's I would say a very important question. I would say a very key question. Generally, what happens is that you if you are looking at the markets, you need to understand that options, when you're trading in options, as I said, these are trading instruments. You should not look at options or futures from an investing perspective. If you want to invest, then you should ideally trade in the cash market segment, or you can use your options and futures to hedge your positions. So, coming to which stocks to enter in call or put, definitely there are ways of knowing it, and that one can look at technical analysis. And Angel also, we have our reports that comes out and our calls that come out, which can help you decide which stocks to trade. But basically, when you are bullish on a particular stock, you need to buy a call option, and if you are bearish on a particular stock, you need to buy a put option. And there are different ways. I would say technical analysis is a way of looking at stocks. Then you also have a way of understanding the open interest. If there is an open interest build up in a particular stock, then that means that there is some interest that is happening in that particular stock. So then you can, if there is some information or some fundamental news that's coming in that particular stock, that can help you. Like recently, as I said about the real estate companies, they rallied significantly. About the housing finance companies, they rallied significantly. So somewhere or the other, there are some fundamental reasons behind that. But from a short-term trading perspective, technicals are something which are very important and crucial, which can help you. If you have any further queries, also you can reach out to us, and we will address that. Uh, we will take the next question. Uh, we can we renew contracts in options before expiry to next expiry by taking additionally how to decide stop loss in options? That's a very good question. The first part is that yes, you can renew your contracts and options with expiry. You can roll over. That's that you square off your position in this contract which is about to expire, and you simultaneously build up a position in the next month expiry. Majorly, you will find that the most liquid, you should trade ideally in the most liquid of options, even if you're trading stock options, because if you're trading Nifty and Bank Nifty, they are the most liquid, so you can trade some out of money also, and options. So there also you'll find liquidity. But in stock options, you need to be careful. You should definitely, before buying a stock option, as to what is the total volume that has happened in that particular stock, what is the open interest. Otherwise, you could get trapped also if there is not much liquidity in that particular stock option. Now, and how to decide stop loss in options? That's a very good question. Generally, what happens is that the best way to decide or have a stop loss is there are a couple of ways. I will just share a few ways. One is that if you're buying, say for example, Reliance stock at Reliance is 1070, you're buying say at Reliance call option, and which is 1100 strike is trading at 14 rupees. So you can see that where Reliance has a technical support. So if it is at say 1050, so you should hold your call option till the time 1050 is not hit. So that is one way. The second is that many people or many traders, what they do is they put a stop loss at 50% of the option, and whatever is the option, they use that as a stop loss. But that's just a ballpark as to what they use. So that's another way of looking at options. The other way is to look at the low of the option. What is been the recent low of the option, and they use it to put a stop loss below that. Uh, Then we shall take the next question. I want to understand how it is calculated for if today's value is 9 and stock is not moving, after how many days will it fall to 6. So that is something which would vary on the volatility of that particular stock. So there you will have to look at the theta of that particular stock. It would vary from stock to stock. There would not be any specific answer per se. Then which we'll take the next question: which stock to buy right now? So ideally, if you look at which stocks to buy right now, I'll talk about specific industries. We have seen significant upside movement in the technology stocks. So technology stocks are still seeing some upside. That's one. Secondly, any pullback in real estate stocks is also something you can look at, because real estate as a sector is finding opportunities there. And apart from that, you have to wait for the banking sector for the budget, because there could be something for the banking sector in the budget. So these are specific sectors which you can look at. IT stocks, IT stocks could be like Mindtree is a good opportunity. You can look at that. Tata Motors had recently rallied. So, but you'll have to understand that stocks are good, but the question is when to buy. That's one, and secondly, where to exit. That is where the stop loss ideally should be. So that's there. We'll take the next question. Is it a good idea to invest only in top 5 large caps? Uh, Ideally, it's not a very good idea, for the simple reason is that if you are restricting yourself to the top 5 large caps, so in that case, if those 5 large caps have not performed well, but the overall markets have performed well, so net net you will end up losing money, or you will end up not making money. So the rather it should be that how can one identify blue chips or identified well diversified companies which are large cap or which are mid cap sector, which are in the mid cap sector, and you invest in those from a medium term to long term perspective. So, so ideally, I would say not one should not restrict oneself to only 5 stocks or 10 stocks. That's one. And secondly, one should also not restrict oneself only to a specific sector. Just to give you an example, earlier the pharma sector used to be the darling of all sectors, but today the pharma sector is in the news for all the wrong reasons. Somewhere or the other, there is this US FDA warning letter or some ruling comes, and we see a significant correction in the pharma sector. Likewise, if you look at the IT sector, earlier IT sector was again the darling of the markets. It was among the top performing sectors, but after the Brexit issue, the markets have IT sector has seen a significant correction, and again now it is currently the markets are digesting the fact, and we've seen some upside. Then, so we'll take the last question right now. What do you think about GST? This is something which was to be rolled out on the 1st of April, but I don't think that is going to happen. At least maybe it could move up to September, as was being said. It is a major development and a revolutionary, I would say, step, no doubt. But once it gets implemented, yes, then that could have its own advantages. That it would really lead to a lot of cost savings on the transportation side. It could also have a positive impact on the inflationary side, because that could lead to overall reduction in cost, reduction in time, because there could be turnaround times would reduce, and there would be significant advantages. That's the reason we saw earlier significant rallies in logistic companies, but then they've seen some profit booking also. So this is a positive step, and a big step and a bold step by the governments, but still it's yet to see the light of the day. So we'll have to wait for that till we get that in place. And uh, we'll take the last question. due to some news, it came into picture like Divi's Lab, shall we enter in such type of stock? Generally, what happens is that Divi's Lab, as a company, overall, if you see, it was doing very well. But as I said, that pharma sector is such a sector which currently is in the is in the news for the wrong reasons, and any adverse effect, I would say not effect, any adverse ruling or warning by the US FDA on a plant and on a product has a knee-jerk reaction in the markets. So that's a cause of concern. So yes, pharma sector, what you should do is, there's no doubt that earlier we had seen a major correction in Sun Pharma, we had seen a major correction in Dr. Reddy's lab, then DV's lab, then Aurobindo Pharma. Almost every other Alchem also had witnessed a major selling. So the point what I'm trying to say is that you have these negative news flows will be there in the pharma space, but over a period of time, they should be, the Indian pharma companies should be well positioned to really overcome these challenges, and they would rise to that level. But yes, if so, it is your choice. You can decide to stay invested in the pharma sector. Here, what I would suggest is that you could also look at the market from a technical perspective. You can look at where the long-term supports of the pharma companies, pharma stocks are on the charts, and that can help you. For that, you can also look at our advanced charting software which Angel offers. So that's available to our clients for free, and that can give you that advantage. So that's something you can do. Uh, So now we shall conclude this session. I have a request from all of you. I really appreciate the time and patience that you have shown for attending this seminar. It also gives us a satisfaction that we try to do what best we can for our clients, and I really appreciate. So there would be an email which would be sent to you for your feedback and feedback. So kindly at the end of the session, you will be getting a mail to that effect. So kindly revert on that and fill in the survey. Thank you so much for your time, and have a nice evening.